Welcome to Dig Deep, the mining podcast. In this podcast, we go deep into mining news, hot topics, and live interviews with mining professionals and leading figures in the mining industry. Introducing your host, Rob Tyson, founder and director of Mining International and Mining International Executive, a leading global mining recruitment and headhunting agency.
Hi mining community, welcome back to another episode of the Dig Deep, the mining podcast, and we have a returning guest who appeared back in March 2022, just over 2.5 years ago, which was episode 226. Alan Clegg, who has a long and established career in the mining industry for over 4 decades, working in various aspects of metals and mining, from value chain through to exploration and mine closure, and he's also been involved in financing of projects, project management, construction and execution. So basically, he's done it all. He's published more than 20 technical papers and presented at numerous international conferences. And we're just going to have a talk about a variety of different topics, including precious metals, PGMs, the energy transition, ESG, just to name a few topics. So Alan, welcome to the podcast again. How are you doing?
Oh, thanks, Rob. It's good to be back, man. I can't believe it's 2 years already. It's incredible how time flies. So, it's a lot has happened in the last 2 years. We have a very volatile metals and mining and energy industry worldwide. Lots happening. Great to be back and to chat about various issues.
Yeah, great. As we are, obviously, if those that are listening, if you didn't hear the previous episode when we spoke with Alan 2.5 years ago, Alan, I was just wondering if you can just tell us a little bit about, obviously, yourself, your career. As I mentioned, you've been in the mining industry for over 40 years. I just wonder if you just tell us a little bit about yourself, about your career, so our audience knows a little bit about yourself and about your background.
Yeah, sure, Rob, I can. Actually, it's quite scary if I think that I started my career in 1974 in the British National Coal Board. So it's now 50 years. It's unbelievable how time has flown. And basically, I've sort of based myself in South Africa since 1976. So I'm still a UK citizen with residency in South Africa. And as you said, I mean, I've spent the last 50 years working in natural resource, mining and energy projects, development and construction, in more than 40 African and more than 150 countries across all the continents in that time period. So I am obviously a professional mining engineer by trade, but also a professional construction manager, project manager. And I've done a lot of conferences as well and putting back into the industry. And I do a lot of mineral asset and resources, technical assessment, reporting, and act as a competent valuator. So, and I've done quite a lot with stock exchange listings. I've listed 8 companies in my career. So, and still today, I do quite a bit of advisory work in the investment space and private equity. So, in all commodities, really. I've worked in gold, platinum, infrastructure metals, energy fuels, energy metals, bulk commodities, dimensional stone, pretty much everything over the last many decades. So, and also been involved with governments too. I've advised a number of governments on mining policy, legislation and regulation since around 1990. So I've had a varied and blessed career and worked with some amazing people and teams, of course, over that period.
Yeah, just carrying on from that, you're currently in New Zealand at the moment of the time of this recording. So I just wondered, if you can just tell us a little bit why you're out in New Zealand at the moment. Obviously, you live in South Africa, but you're currently obviously in New Zealand. So just wondered if you just tell us how comes you're out there?
Well, it's an interesting question, actually. I mean, I'm sort of always interested in what's happening in my industry in the world. And 2 years ago, my children and grandchildren emigrated to New Zealand. So we came sort of to visit them last year. And I noticed that there'd just been a change in government for the first time in 18 years, there was a new, more centre-right government, and they had started to, with clear policies, to effectively restart the mining and energy industries in New Zealand, which had been, for all intents and purposes, I wouldn't go as far as saying banned, but effectively shut down any new development by the previous very socialist governments. And the net result is that the country got into and is in, pretty much a serious economic situation right now, where they're facing the energy cliff, and there's been no mining and mineral resources development, and they're having to import everything, and industries are falling over because of the high costs of importation. So it's quite insane when they have quite a good mineral endowment here, and also energy fuels and so on. So I reached out and connected with the government, and have made a number of advisory submissions to them on how they might redress the situation. So while I'm here, I've been discussing with them, and then also with this renewed environment, we have a number of listed companies, junior companies, and a couple of mid-tier companies from Australia and Canada who are looking to capitalize on the new government's attitude and the opportunities that exist in New Zealand. So I'm in contact with a few of them, and looking at, while I'm here, to actually be useful to people, and see what we can do to assist. So yeah, it's quite an interesting environment. And interestingly, a very long history in mining. Gold mining has been going on, or started in New Zealand since the late 1800s, and they had some very, very rich gold mines in this part of the world, and they've also got a history of coal mining as well. So yeah, quite interesting.
Yeah, if we're obviously going to start talking about commodities, and I suppose we can start with gold, and I suppose over the last, I don't know, of course of this year, obviously things are going well for gold. I wondered if you can just give us your point of view on the gold market and what's been happening more recently, I suppose, in the case of 2024, and what your expectations are of gold in current times.
Yeah, okay. It's a good question, actually. Well, gold, of course, for more than 5,000 years has been seen as a store of wealth. And while the general consensus is that gold is not an investment for most people, because it doesn't earn a dividend or an annual return per se, and it can be quite volatile price-wise. But it's remained over that time frame, an ounce of gold 5,000 years ago is an ounce of gold today. And although we may see, the price of that ounce fluctuate, it's not really a reflection of the value of gold per se, but rather the price moves with effectively the depreciation of the fiat currency with which it's measured by. So in this case, the US dollar. So what we've been seeing is we're seeing that certainly recently, well, we've had a 38% increase in the price of gold over the last around 18 months. And fundamentally, that's really as a reaction to it being a safe haven, and the global debt situation in the US and the major G7 and even the G20 countries has been on the increase, money printing and so on. The US debt's now exceeding 32 trillion. And so there's a lot of fear out there about the failure of the fiat currency system. And you've seen massive buying of gold by the central banks. And 2 years ago, you had the central bank of central banks, the Bank of International Settlements in Switzerland, declared gold as a tier 1 asset for the first time. So now all the central banks have been piling in. And then certain countries like India, like China, don't allow the export of gold anymore. So all the gold that they're mining in that country is staying in the country, and it's either being bought by the average citizen or bought by their various banks. In China, of course, well, at least the official statistics is that the Chinese central bank has about 2,500 tons of gold. And of course, the Americans say that they have 8,500 tons of gold. But we all know China has far more gold than anybody else because, I mean, they mine the most gold on an annual basis, roughly around 550 to 600 tons of gold and on an annual basis, which they don't export. And then they're a huge importer of gold on top of it. So, I mean, the current estimates by people who have really been tracking it is that China may have as much as 30,000 tons of gold in the country as a whole. Now, this is a hedge against, of course, fiat currency failure. So there's a number of experts who are predicting that, the gold, there could be a major reset and that currencies could be attached to gold again. I mean, we've had no gold standard since 1971, since Nixon took away the gold standard and allowed the dollar to float, and then revalued gold immediately at that time. At the time, from $22 up to $35. And of course, then gold rapidly increased to above $200 and was stayed there for a long time. And it's fluctuated up and down, but now it's really in the ascendancy. And I mean, there are a number of people out there talking about gold, and some people are saying that gold could end up being $15,000 an ounce, by 2035, and others are saying 9,000. I mean, I don't think anybody's crystal ball is better than the other one, but one thing is for sure is that precious metals as a whole, gold is money. It's the only true form of money. And of course, don't forget silver, because I mean, silver was money even before gold was money. So precious metals in general, I think, has a strong future still. How it's going to fit into the monetary system, it's yet to be seen. I mean, we're seeing the world's central bankers, we're seeing the IMF, the World Bank, the G7 finance ministers all talking about things like central bank digital currencies and to replace, so taking away fiat money, cash money will disappear. I mean, some countries are already in that space. I mean, the Scandinavian countries, for example, Sweden. I mean, if you go to Sweden today, they don't accept cash. Doesn't matter what you've got cash, dollar, euro, pounds, doesn't matter. If you haven't got a debit card or a credit card, you can't do anything. They effectively have gone electronic already. And you're seeing other parts of the world where they are taking large denomination bills out of the system as an experiment. I mean, India took out the 5,000 rupee, note, then the 1,000, and there was plans to take out the 500 rupee note as well. And they gave the entire population 72 hours to come and deposit everything they had in the bank. Otherwise, it would be basically toilet paper, worthless. And of course, when people did that, it's really as an act by the government to bank the unbanked and to bring cash from under the bed into the system and tax it, because they don't know where those earnings have come from. So they applied a flat tax of 25%. So these are the types of things that governments can do. And so the precious metals, gold, silver, etc., are a store of wealth. And it's a hedge against, as I said, the failure of the fiat currency system. So going forward, it's going to get scarcer. It's more difficult to obtain. I mean, even today, if you want to go out and buy a gold USA Gold Eagle or in South Africa Krugerrands, you can't go and buy it straight from the shop. Normally, you have to order it these days. And the last time I bought, it took me a month to get my coins. So, and that's because you see quantities of gold being mined is on the decline. I mean, there's less gold mined each and every year, and the gold supply is only been increasing previously around 1.5% to 2% per annum. But now physical mining is in decline. The number of gold mines out there are less, and so with lesser supply on the market and huge demand, only one thing can happen. Of course, when you talk precious metals, you can also bring into the equation PGMs as well. I mean, in particular, platinum has some investment value. I mean, it's been very well used in the jewelry market for some time, and also high-end things like watches, high-value watches in platinum cases and things like that. So from that perspective, a portion of platinum, which is more or less an industrial precious metal, as being used more and more for investment too. So, and then you see some countries who have started to try and peg their currency to baskets of metals, which typically include gold, silver, and platinum, sometimes palladium. Most recently, Zimbabwe was one that did that. They introduced a new unit which was linked to those metals, as well as other metals as well, other commodities such as copper and lithium even. So I think ultimately, if fiat currency does disappear, we may end up with a unit that would be backed by a basket of commodities. I don't see in the short term the US dollar disappearing as the reserve currency, for example. I think it's in decline, certainly. I mean, we have the BRICS countries who are clearly trying to formulate a new system for trade, which probably will be backed by a basket of metals and commodities. And ultimately that will emerge. And you've seen, of course, the petrodollar has already been seriously impacted. I mean, even 5 years ago, I think probably 98% of trades in oil was done by the petrodollar, whereas today, I think that's reduced now dramatically. And if I'm not wrong, I think in 2023, just over 20% of all oil trades was not done in the US dollar, but it was done in other currencies. So yeah, we're in a rather turbulent period, I think, in history, where commodities, and in particular precious metals in the context of the current discussion right now, is on the rise and will have a stronger place as we move forward.
Yeah. Just staying on gold, obviously you mentioned central banks have increasingly purchased over the last few years more and more gold. Do you think there will be a revaluation of gold like they did back in, I think, obviously in the 1970s? Or no, actually, no, back in I think the 30s, when they did revalue gold from $20 to $35. Do you think a similar thing where they will revalue gold at a higher price, do you think that will happen in the near future?
Well, I think the writing's certainly on the wall, and the question is, when will it happen? To a large degree, I think the market is already revaluing gold. I mean, this is why you've seen gold pretty much skyrocket and gone from around $1,750 an ounce to $2,700 an ounce, and it keeps reaching all-time highs. We've seen a recent sort of fallback, which is natural as a result of the US election result, because Trump is seen as being very good for the equities markets and probably not so good for gold. Of course, it's all sentiment driven. It has come back somewhat again since its drop after the election result, and it's going back up towards the 2,700, and some of the main gold analysts are still predicting that it could get close to 3,000 by the end of the year, driven simply by the simple fact that the debt situation, inflation, which is not really being tamed, etc., are all features for the gold price to accelerate. And whether there's a physical, actual revaluing, I think that will be a decision that's more than likely going to be made by the IMF and the World Bank, and probably the G7 finance ministers. The main countries will get together and decide on that, and everybody else will sort of follow suit. And where that number will be, who knows? As I said earlier, I mean, I've seen predictions of people who know far more about the part of the world, of the financial world, than I do, and anywhere between $5,500 and $15,000 an ounce is where it could be revalued to. Now, of course, for people that have got a very large debt situation, like the US, for example, I mean, they claim they have 8,500 tons of gold, more or less. Well, on the Fed's balance sheet at the moment, it's only valued, I think, at somewhere in the region of $35 an ounce. Well, if that was to be revalued to 15,000, of course, that would be a big net positive and offset for them to deal with the balance sheet that they have at the Federal Reserve. So who knows what they will do? But I certainly believe that there could be a revaluation. The question is, when will they do it? I don't think anyone could really predict. But in general, if you look at the gold miners, I mean, of course, typically the valuation of the miners follows the gold price. So first gold moves and then the miners move, because obviously if the price goes up, they have a bigger earnings opportunity. Although at the same time, we have seen, while gold has gone from say 1750 to 2700, huge rise, you haven't seen a commensurate rise in profits in the big gold miners. Why? Well, because of the inflation costs of fuel, costs of labor, costs of materials. Inflation has run rampant and really is not at the ridiculously low levels, core inflation that the US says is, in the low twos. Well, I mean, we all know that's nonsense. I mean, the real inflation that people feel in the pocket and industries feels is in, if it's not in double figures, it's certainly in the high single figures. So inflation impacts have had a big toll on profits of mines. But as long as the gold price stays at the current levels and above, and if inflation and cost management does take hold, then I think you will see higher profits and higher dividends, and therefore the share prices of gold equities and other mining equities are likely to follow suit. And of course, you see the tier one miners are the ones that move first, the Newmonts and the Barricks of this world. And then you'll see the mid caps and of course the juniors, the explorers, they will follow much later. But you're definitely going to see and are seeing M&A activity and consolidation in the marketplace, with a big players buying up the possibility of new resources and new reserves in their pipeline going forward. And I think you're going to see more and more M&A activity in the precious metal space.
Yeah. If we look at the other precious metal, silver, again, there's been a sharp increase in price of silver, which obviously not many people necessarily talk about. The focus is always on gold. So just wondering if you can just tell us a little bit about your thoughts on the silver market, and what you expect to happen over the near future.
Well, silver, of course, is principally an industrial precious metal, and it goes into mainly electronics. And of course, the big driver for the consumption of silver has been solar panels. The whole renewable energy business, in particular solar photovoltaic panels, as a huge consumer of that. And as a result, you've seen large amounts of silver buying and hoarding of silver. And recently, China has banned the export of silver as well. So, and silver is somewhat different to gold in that it's not as rare as gold, but at the same time, because of the demand, the deficit in silver is actually quite large. I mean, the most recent numbers that I was looking at is that in 2024, you're probably looking at a net deficit of around 700 to 800,000 ounces of silver, which is quite large. And they reckon that's going to get higher because the silver miners have been sitting on their production and not releasing it into the market, looking for the higher prices. I mean, the sort of break-even price, I think, for most of the pure silver miners is probably somewhere around the $20 to $22 an ounce mark. So, higher prices helps them a lot. And of course, most silver is not produced from pure silver miners, but as a byproduct of base metal mining. I mean, one of the biggest silver producers in the world is KHGM in Poland, which is effectively a copper miner, but they produce huge amounts of silver on an annual basis as a byproduct metal. So the silver market, as I said earlier, also silver was money before gold, and I think for the average man in the street, it's far easier to carve off, $100 a month and then go and buy 3 silver eagles or the equivalent in Australia or South Africa ounces of silver. It's much easier to buy that as a hedge. If silver goes to the price levels that some of the analysts are predicting, I mean, there's something called the gold-silver ratio, which has, been measured quite heavily by the market analysts. I mean, in the Earth's crust, the sort of reference point is somewhere around 16 to 1 ounces of silver to an ounce of gold. And at the moment, if the trading of silver is around, it's in the 80s, probably around 80 to 83, I guess, ounces of silver to 1 ounce of gold on a dollar price basis. So it's much cheaper and more accessible for the average man to make a store of wealth and buy a few coins every month. Not everybody can shell out $2,700 a month to buy a 1 ounce gold coin, but they can certainly shell out a couple of $100 and buy silver coins. So there is quite a lot of that. More and more people, even in my own personal circle, I have friends of people that are buying silver. So it's like the poor man's gold, if you like. There's a retail demand that's growing among the general population that are becoming aware that these things are stores of wealth, and they're likely to appreciate faster than some other things that they may invest in. And then, of course, you've got this industrial market, the so-called green transition, the drive for more and more renewable energy. And of course, the later solar panels that are being produced, the more efficient ones, have higher and higher percentages of silver in their manufacture. So, with a large deficit, some of the miners holding on for better prices, a big demand from the renewable market, a retail demand, I think the future for silver is very good. And I mean, I've seen price predictions as high as $200 an ounce for silver. And if you think about it, if we get a mean reversion, I think the mean gold-silver ratio over the last 50 years is somewhere in the region of around, I think, 45 to 1. So even if we get a reversion to that mean level of 45 to 1, when it's currently at 80 plus to 1, then you're going to see a significant appreciation in the value of silver. And once again, I must emphasize that these price appreciations per ounce of silver or gold is really not related to the change in the value. It's still an ounce of silver and it's still an ounce of gold, but what you're seeing is the price increase, as the impact is a result of the depreciation of the fiat currency, which is used as the measure for the value of that ounce of silver or gold. So that's what you really see, and those are the inflation impacts that's manifested in the value of the fiat currency, which you then see in the appreciation of the store of wealth, the precious metal.
Yeah. And obviously, being from South Africa, we need to speak about PGMs. They've obviously had a rough ride recently. Just wonder what your thoughts are on the PGM market.
I remain fairly optimistic about PGMs. Look, it has been extremely volatile. I mean, it's essentially they're precious metals for industry. And of course, a lot of it's been focused around ICE or internal combustion engine vehicles and catalytic converters for control of pollutive emissions and so on. And of course, with the advent of all things electric, the EV space, the electric vehicle production, and everybody's saying, oh, well, EVs are going to take over the world. And I mean, the earliest predictions were that by 2025, we won't have any internal combustion engine vehicles left. And of course, many of the mainstream economies, like the UK, initially said, well, they'll ban all sales of internal combustion engine vehicles by 2030. They then changed that to 2035. And now they're not even sure about that. And the same in Europe, of course, and elsewhere, because what people have realized is that, it's not easy. It's not a light switch to go electrification, to simply switch from an internal combustion engine vehicle to an electric vehicle. So from a platinum perspective, that has meant that there has been, I mean, the World Platinum Council, I think the last report I saw said that there's a market deficit looming of up to 1 million ounces of platinum. And that, of course, is because some of the producers in South Africa and elsewhere have really taken the opportunity of low prices to go into executing long-term outstanding maintenance programs. They've been shutting down refineries, shutting down major concentrator plants. And so they've been building up stocks of ore and or concentrate while these maintenance regimes are being done. And so primary production has been falling. That's helped stabilize the price. It's created something of a deficit. Of course, there are also new technologies that were slated as going to support the PGM industry, and there would be no worries if ICE vehicles disappeared and EVs were there. It doesn't matter about the catalysts, because there'll be other technologies like electrolytic catalyzers, for example, for production of hydrogen and green hydrogen, which use quite significant amounts of PGMs. Of course, the whole hydrogen story as well has lost momentum as people have realized that these narratives, when you really look at the science and the physics and the engineering facts, actually are, they're like sieves. They're full of holes. I mean, hydrogen as a fuel is a square wheel, let's face it. I mean, hydrogen is not a source of primary energy. Hydrogen it can be a store of energy, but that's all. But it's extremely expensive to produce, and especially if you want to produce what they call green hydrogen. There are many forms, of course. There's green and blue and grey and all the colours of the rainbow, depending on the source, of course, of production of that particular hydrogen gas. And of course, hydrogen is notoriously difficult to transport. It's very volatile. So there's lots of problems with that. So I think, one thing I firmly believe in, Rob, is something called mean reversion. And you will continually get, as you go through periods where you get a large swing of the pendulum to one way, like we've had this huge swing towards renewable energy and all things will be electrified and electric vehicles, and driven by government narratives, unelected bodies saying that, we have to protect the planet. And so this has impacted heavily on sentiment around these various metals. But of course, ultimately, politics can't fight with physics. Physics is physics. So it doesn't matter what story the politicians would like to create. Ultimately, the facts of physics will rule, and you will get mean reversion, and sense will have to prevail. And that's what we're seeing now. I mean, the electric vehicle industry, as while everybody says, yeah, we've sold more and more electric vehicles, well, not really. China, 75% of the electric vehicle market. But China is an outlier. It's not the rest of the world. The Chinese government are producing electrification they've electrified their system with fossil fuels. I mean, Chinese have been building, rolling out 1 gigawatt of new coal-fired power, every week for the last 3, 4, 5 years. And so they have this huge amount of coal. They also import as well, and producing very, very cheap energy, which we then use to produce solar panels to sell to the rest of the world. So, and same producing electric vehicles. The Chinese electric vehicle exports have just exploded, and they're taking over many of the mainstream markets, huge amounts. For example, I was just reading an article yesterday about Mexico. The Mexican market has now 60% imported vehicles from China. So they've effectively crippled the US export market of ICE vehicles into Mexico, and even electric vehicles from the likes of GM and Ford, because the Chinese can get them there better and cheaper. So there's a lot of things happening there. So I think PGMs in general will continue to have a stable future, and ICE vehicles are not going anywhere. Of course, there's a lot of misinformation about how an electric vehicle is net zero and all that, which of course is pure nonsense. I mean, if you measure it at the tailpipe, which of course it doesn't have, yeah, then it has obviously none of the traditional emissions that one would expect. But if you look at the value chain of the average electric vehicle that has a 75 kilowatt hour battery, then of course 70% of the actual emissions, the emissions in the value chain are in the logistics around producing that electric vehicle. So you can mine the raw materials, the metals in Africa, powered by coal-fired power. You then put the concentrates on a ship or the metals, and you send them all the way to China in a heavy fuel oil fired bulk carrier, and then it arrives in China, and then it's manufactured using coal-fired power with emissions, and so on and so forth. So when you add it up, if you do a real carbon balance sheet, which I have done many times, you will see that in fact the carbon footprint of a similar sized electric vehicle is actually higher in an electric vehicle than it is in an internal combustion engine vehicle with modern emissions control. So, there's a lot of misinformation out there, and ultimately, yeah, as I said, I believe in mean reversion. Common sense will prevail. We have to adopt new technologies, but ultimately it's about finding the balance. It's not, one way or the other. It's about finding the balance. And of course, ultimately, what is the driving factor behind all this and these technologies? And of course, the need for the commodities which we mine is, of course, the whole question of climate change, or let's say the catastrophization of climate change, which is driven by the political machine, of course, and these unelected bodies like the World Economic Forum and so on and so forth. I mean, the truth there is also coming home to roost. That, I mean, does climate change exist? Of course it exists. I mean, anybody who says that climate change is not real to me, has got serious, cognitive dissonance. I mean, climate change is a reality. But having said that, to catastrophize climate events is wrong, because it's not true. I mean, the facts are out there. The empirical evidence shows we have no more storms, no more hurricanes, no more tornadoes, no more floods than we've ever had before. And in fact, the amount of people and the deaths as a result of that is lower than they ever were before, because of the resilience of society since the Industrial Revolution, having energy, being able to produce a living standard and infrastructure systems that are more resilient. Yes, some infrastructure systems are old now and need re-engineering and so on and so forth. But the reality is that this catastrophic message that's put out there that the world is ending by Al Gore and the merry people at COP29 and so on is just ridiculous, because it's not reality. If one thinks about it in reality, anthropogenic climate change, have we had an impact on emissions and probably weather systems on a localized basis? Without doubt we have. But is anthropogenic impacts more powerful than the Earth itself? No, the empirical evidence shows not. The Earth will do what the Earth will do, regardless of us ants that we call humans, who have the arrogance to believe, like Al Gore, that anything we can do, we can tune the Earth like we tune an engine in a car. I'm sorry, that's just not realistic at all, in my view. And many others, of course, and you will see more and more news and more empirical evidence has been shown debunking this catastrophe that's being put forward to us, and it's really not helpful at all to do that. One has to be realistic, focus on empirical evidence, focus on things that we can genuinely control, be responsible citizens. Obviously, we want to control emissions, but to premise and predicate everything we do on the back of decarbonisation is insanity. I mean, CO2 is not a pollutant. Let me say that again. It's not a pollutant. I mean, it's fundamental to life. And yet we don't see anybody talking about the real problems, which are carbon monoxide, sulfur dioxide, nitrous oxides, particulate matter, for example. Municipal solid wastes, the uncontrolled wastes from mining historically, and so on and so forth. So there's many other problems, plastic, many other problems in the world that need addressing, and yet we seem to focus on something that's not a pollutant and blame the human race for everything that's ever happened. So it's a little bit skewed, but as I say again, I think we're seeing mean reversion, we're seeing common sense prevail, and more we will see that things will come back to a more sensible position where we can use the phenomenal technologies that are available in order to produce energy in a clean and controlled manner. I mean, there's no reason for coal-fired power plants to be dirty. I mean, a clean coal technology power plant, there are many have been built in the world. I mean, the latest ones in China are like that, Japan, South Korea, even in the US, there's some of these plants now. And, those on a megawatt for megawatt basis have a lower carbon footprint than a solar PV generation system or a wind farm. So I think it's all about balance and truth, and no doubt we have to have an energy system that is balanced, and there will be new technologies. Definitely renewables, solar and wind will be part of the system, but are they going to be the total system? Are we going to eradicate fossil fuels and the commodities that feed those industries? Definitely not. It's really is just not realistic at all. I mean, if you think 15 years ago, 85% of primary energy was from fossil fuels. In the last 15 years, the world has deployed, well, the numbers vary, but somewhere between $8 and $9 trillion on renewable energy systems. And what has happened? Well, we've got 3% of primary energies from renewables. We still have over 81% of primary energy coming from fossil fuels, oil, gas, coal, etc. So how can we imagine that by 2050 we're going to eradicate that when it's taken us 15 years and $9 trillion to replace 3% of the world's primary energy? It's just not realistic, and one has to use common sense and look at those metrics. It's just not happening.
Yep, and moving along, obviously the commodities, we look at obviously critical minerals and battery metals, as obviously you alluded to in talking about EVs. Some say the bubble's already burst in this sector. Some still think there's obviously a long way to go. What are your thoughts on the whole critical minerals and battery metals space?
Yeah, it's also a very good question. But again, as an engineer and a scientist, I try and go back to the fundamentals of my industry and look at what's available in the world and look at what has been projected for the amount, for example, of of the rollout of what's referred to as the green transition, because it always focused around that. And of course, at this point, before I continue, is to say that, there is no such thing as a green transition or the energy transition. That doesn't exist. If you look at the facts, it's actually an energy addition. We're actually adding more energy generation. We're not replacing anything. We're not transitioning anything. As I just pointed out, in 15 years, we've gone from 85% of primary energy by fossil fuels to 81% or close to 82%. So we know there's no transition. There's just more energy generation being added with different systems at a very high cost. Now, if you transfer that and convert that to the amount of critical minerals and metals that we need to drive this political term green transition and go to renewables, I mean, you just have to go back and do the math on the estimated total quantity of metals to manufacture, let's say, one generation of renewable technology units to completely phase out fossil fuels. So in other words, to replace the existing system. Now, if you do that math, you will see that the quantity is far larger than anybody's ever thought of, or any existing strategic thinking allows for. It's just absolutely staggering. I mean, if you, as a reference point, as I did, you go back and you look at global production capacity, mining or refining from 2019. So in the let's say pre-pandemic, if you look at that of the minerals, it simply was not adequate to manufacture the non-fossil fuel technology that's being proposed by the green transition in a full system replacement. It's never going to happen. I mean, if you look at the total quantity of metal produced in the period from, let's say, 1990 to 2023, that period, it's not enough to supply the needed metal feedstock. And forget about recycling, because that cannot be the primary source of metal for the first generation of renewable technology units. There's just not enough in the system to enable enough recycling. So what does this mean? I mean, this means that the sourcing of metals are going to have to be delivered from new primary mining of those critical metals and minerals. So what does that mean? Well, something to consider is that more mineralized deposits will need to be accessible through mining with the support of cheap energy, i.e. base load fossil fuel energy, which has a much higher energy return on the energy investment than mining with the support of renewables, for example, because we all know that renewable energy cannot fully support a tier one mining operation that produces, 1 million tons a year of copper, for example. It's just not realistic. It doesn't happen. So, that fact, and if you look at the numbers and break it down to the final math, there's just not enough mining production or indeed mineral reserves to deliver enough metal to manufacture enough of these renewable energy systems, in particular the batteries, because the key to the replacement of the fossil fuel system, of course, is batteries. I mean, without battery storage, it's because of the intermittent nature of renewables, you cannot do it. It's just not going to work. Most of the metals, critical minerals, are going to go into the battery systems. The big question is, how many batteries do you need in order to have an equivalent of fossil fuel driven baseload power? Well, there's lots of debate around that. Some people say, well, you need enough for 6 hours. Some people say 12 hours. Some people say 28 days. Some people say 3 months. What the real number is, I don't really know, but my sense is that it's closer to the 1 to 3 months range than it is, the hours. So that means that the amount of batteries that you're going to need for that the amount of metals to manufacture enough batteries to do that, is to produce that power buffer is just not there. Because we have to have that if you're going to meet power grid stability requirements through the seasonal changes and the large swings in power production for wind power. You're really going to need that storage capacity. As we are at the moment, it's just not happening. And clearly wind and solar are not viable to be a primary energy source for the industrial era going forward as we see it. I mean, one of the big ones, of course, is to look at is copper. I mean, this is the one commodity that is not replaceable. In an electrification of our industrial system on any scale, it needs vast quantities of copper. Now, there are some people that say, oh, yeah, but we can use aluminium. It's more available. But aluminium to produce aluminium is massively energy intensive, much more energy intensive than copper. And while it can be used in some applications, it's not practical due to the energy requirements to produce it. And then, it has other negatives as well, does aluminium, particularly for transmission lines, for example, because of aluminium's its physical characteristics means that in order to transfer energy in an overhead power line, I mean, the diameter of the cables you need is much larger, and therefore, again, it has practical implications in terms of using it for that. I mean, traditionally, copper is a metal that reflects demand from development of technology, and today it's no different. I mean, demand has been projected to continue to grow at an annual rate of around 2.5% since the sort of 2020 to 2050 period. I saw a study not long ago by S&P Global that was stating those numbers. Several other people have done that as well. So if the global copper market demand does in fact grow from the current 25 million tons to 50 million metric tons by 2050, we're in serious trouble. And already the shortfall is predicted to be close to 10 million tons by 2035. So just based on the current build out of electrification systems, that's really, let's call it work in progress right now. And if you look at copper over time, well, let's say human history, the number that everyone seems to have fixed on is that we've probably produced around 700 million tons over a 4,000 year period or so, up to 2020. So, for global economic demand for copper to continue on this trajectory it has at the moment, we're going to need a similar amount. We're going to need another 700 million tons. And that's got to be produced not in 4,000 years, but in the next a little over 20 years, or 22 or 24 years. So that's not going to happen. And again, if you then translate that to the current amount of copper reserves that we have, I think the latest US Geological Survey number for this year was somewhere close to 900 million tons, if I'm not wrong. Might be a bit less, but that sort of order. I mean, that would allow for about 30 years of production at the current, at the growth rate that was projected to, replace fossil fuels as a generation system by electrifying everything. Again, that's not going to happen physically. I mean, counterintuitively, you also have the negative perception of mining, the regulation that's increasing around mining, more and more regulation as impacting. So that's also, has a drag effect and impact on increasing production. And as I said, substitution for copper is not really viable for most applications. As I said earlier, aluminium is the one that everybody punts, but it's only, I think, about 60% as conductive as copper. So you need a larger cross section for the same carrying capability. Aluminium also has a higher voltage drop over time. So there's lots of negatives and that it make it just impractical to use that. And another big factor, of course, in critical minerals development, the average person is not aware of. And I think unless you're in the industry, and many people even in the industry, I don't think are aware that, for every 1,000 or so deposits of metals and minerals that we actually discover, it's only 1 or 2 that become tier 1 producing mines. And then there's the timeline. I mean, given the permitting issues, given the funding, the development time frame, I mean, a tier 1 mine can take anywhere between 10 and 25 years to develop after discovery to a tier 1 producing mine. And for every 9 or 10 producing mines, 2 or 3 mines will go out of business in that same time frame due to reducing or lack of viability for the particular market conditions. I mean, the commodity markets historically is also a boom bust market. I mean, we have an 8 or 10 year boom, and then we have a 8, 9, 10, 12 year bust, and then it goes up again. It's extremely cyclical. And when you factor that into a 10 to 25 year development time frame, or let's say an average of 16 years to produce a major tier 1 copper mine from discovery, you may go through 2 cycles in that time. So the task we have to explore for more of these metals really far exceeds what is practical in terms of the timeframes that's being propagated by the global political machine for this transition to all things electric and so on. It just doesn't compute. The math doesn't work. But that doesn't seem to bother them at all. They continue to catastrophize and blow out and say that, well, we have to do this regardless. So really, in terms of critical minerals, Rob, those that need to be mined, that need to be processed, transported, using production capacity that literally doesn't exist, as well as energy that's currently not available, means that, and can only be provided by conventional energy generation, i.e. fossil fuels, means that, these things that are being propagated are dreams. But what it does mean is that those that are producing, those that are in the development pipeline, will more than likely come into production and will do very well because of the demand and the rise of inflation alone. The inflation impacts means that the commodity prices will go up. So if those that design efficient mines using the latest technologies in terms of processing can become a good business, and therefore there will be good returns for investors and so on and so forth. One of the things that, I must of course mention, and this has a huge impact in the metals and minerals market, and no less in copper, is of course falling grades. If you look at the global grade trajectory of copper mines, 25, 30 years ago, the average grade, in situ grade, would probably be somewhere in the region of 3.5% to 4% copper. Today, most of the tier 1 mines that are in development, at feasibility study level and development, you're looking at grades of 0.37% copper. So what does that mean? That means you need better processing technology, you need more energy. It means you have to strip more waste material. So you're creating more solid waste for every ton of copper you produce. That impacts on the cost to produce, of course. And this means that the price naturally of these commodities has to go up. Depending on who you would talk to today, the break-even price, or let's not use that term, let's say the incentive price for a major copper producer to build a new mine, given the time frames it takes you to develop and build a new mine at tier 1 level. Let's say a mine that's producing 500,000 tons of copper per year. The incentive price that's required for that is somewhere in the region of around $15 a pound right now. Some people would say it's even higher. Some people would say it could be as high as $17 a pound of copper. And where's the copper price at the moment? The copper price is sitting around $7, around that, a pound. So if you're a tier one copper miner, are you going to invest in a new mine? Do you have incentive to do it? Well, the answer is no. And this will drive, of course, more merger and acquisition activity, I think, in the industry. People are out there looking for new opportunities to buy capacity, to buy new mines that are already developed or already have a resource and reserve developed and potentially a feasibility study on the table. Because that's the shortcut, if you like, to sustaining their own business, maintaining production, if not increasing it. So, a lot to consider in the critical metals and mineral space, for sure.
Yeah, if we move on and speak about ESG, which is obviously often talked about in our industry, I just wondered if you can, again, give us some more context around ESG and the policies that are obviously given, and how that will impact across those policies, how they will impact our industry across obviously the many sectors and many commodities that obviously we've just been speaking about. So yeah, just wondering if you just give us your take on the ESG within our industry at the moment.
Yeah, it's one of the subjects which I was hoping you wouldn't bring up. But anyway, look, I have rather strong views as far as the whole ESG movement is concerned, because it has become a movement. I mean, fundamentally, let's go all the way back to when I started my career 50 years ago. And let's face it, the mining industry didn't do itself any favors. It went through periods, not all companies, but many companies and in many jurisdictions, where things were not done responsibly and waste was not controlled, environmental controls were not the best. And the mining companies sought profit, and they went to jurisdictions where there was little or no regulation around environment and so on and so forth. So, but having said that, 25 years on from that, so by the time we got to, the late 90s, the early 2000s, we had a very different situation. I mean, we had emergence of a very strong sense of corporate's responsibility around environmental management. There was a huge movement and requirement to do detailed environmental studies and impact assessments and environmental management programs and plans before one could get a permit to even start a mine. So there was a new culture that was born, I think, through the 90s and then into the early 2000s, where environmental responsibility has been very much entrenched in our industry. And it was a practice that was executed for the most part diligent. On the social side, it's also not new. I mean, corporate social responsibility, or CSR as we used to call it, was something else that emerged. And of course, the publicly listed miners all had a corporate social responsibility report. They all had an environmental report. And then on the governance issues, well, I mean, the governance was fundamentally around ethical behavior, mainly focused around procurement practices, using local industry where possible, supporting local industry and businesses. So the whole fundamentals of ESG have been there forever. They've been there for 25 years at least in various forms. So ESG is not new. But what we have seen in the last 5 years in particular is this miraculous creation of this new industry, this new group of profit seekers called ESG consultants. And they are now the gurus, and the miners are fools and they don't know what to do. And of course, the bankers and the markets and the funders are now hooked onto this. And all of a sudden, if you don't have one of these consultants there who's written a nice ESG report and given you a nice tick, then of course that is a big negative. And you see many of the companies out there, they're literally like whipped dogs, and they're bowing to this whole ESG movement, which has added huge cost, unnecessary cost, because, as I said before, the environmental practices, the social governance practices, all those things were already in place. You can go and pull annual reports from the tier 1 and tier 2 miners from 20 years before now, and you'll see they all have these integrated reporting, corporate social responsibility. It's all there in the annual reports. And they were spending significant amounts of money on those practices on an annual basis. And that's correct. I mean, that's right. I mean, these are the things that as an industry we should be doing. It's our responsibility to do these and to be responsible miners and interact while we're extracting resources with the environment in a responsible manner and not to pollute. These are all a given. I mean, nobody's fighting against that. But this ESG movement has pushed the costs of those elements of mining to ridiculous levels. I mean, probably from somewhere around 2.5% of cost. I mean, I've seen some recent numbers where ESG costs are as high as 18% of the all-in sustaining costs of some tier 1 operations. I mean, that's insane. I mean, that's ridiculous. That 18% could be reinvested in the sustainability of the operations, could be giving a higher return to investors, because, of course, all those expenses is less for distribution to shareholders and stakeholders around. It's, to me, as a bit of an aberration. And of course, the latest trend, which is now even worse, is that the codification organizations out there that have, I mean, we have certain mineral codes, that have developed for mineral resources and mineral reserve definition and so on. And as a competent person, I mean, obviously those are necessary. And there has been a lot of, for want of better terminology, fraud in history. There's been some really big cases out there of false reporting. So these mineral codes and independent application of those by independent competent persons is fundamental to the survival of our industry and to its reputation of the industry. But those organizations that are doing those codes, and of course we have valuation codes. I mean, I'm also a professional valuator, so I'm very much aware of the content of all the various codes. We have Canadian codes, we have Australian codes, South African codes, European. There's a whole bunch of coding organizations that have emerged, most of them pretty similar, but now we have a new push by these codification organizations, and it's been pushed for by bankers. The issue is of finance primarily, that we're now wanting ESG codes or elements of ESG within the codes. Now, of course, these are supposed to be guidelines, to guideline of what we actually do. They are not regulations per se. They are guidelines, but they are being turned into they're being weaponized against the industry. And again, this is counterproductive and counterintuitive to the rapid and responsible development for the production of the critical minerals and metals that we need to be used in the addition of new energy into the marketplace, that we can produce more metals, that we can feed our economies, that we can continue to modernize the world. And the ESG movement is actually working against that, because it's extending timelines, it's slowing things down, it's increasing costs, it's a real inflation factor in the development of new mines. So, yeah, I don't think, as it is structured now and as it has been, it's a rebadging of systems that already existed and as I say, has created this new industry, this new group of consultants that are very expensive, that are basically, in my view, milking shareholders and stakeholders alike, and it's totally unnecessary.
And lastly, I wonder what your take is on the whole, I suppose, financial landscape within the mining industry at the moment. Obviously, we see junior miners struggling to raise finance, and it's been like that for a period of time. I just wonder what your take on the whole financial landscape, and I suppose that is a broad question, and how you see this playing out over the sort of short to medium term, with the obviously money coming in to the mining industry.
Yeah, the junior space is very difficult. Again, I think the junior mining space hasn't done itself any favors and has been through in more recent times, probably the last 10 years, a bad phase where, again, it's a terminology that's been used where managements of these companies are termed as people who are in the industry for the lifestyle that it provides them, rather than focusing on actually developing the assets that they have in their portfolio. So there's a lot of negative perceptions around the junior space, unfortunately, and I guess ultimately one has to look at a number of factors in the junior space, and those that have these factors don't have a problem attracting finance. I mean, the first thing, of course, is the people. Who are the people? Who is the management team involved with that company? What is the track record? What is their experience in developing operations up and down the value chain, and so on? And then, of course, it's the asset itself, the quality of the asset or the potential of the metals and minerals that's being explored for. The jurisdiction, where is the jurisdiction? Is the jurisdiction stable politically, socially, and so on and so forth? And all these factors. So the junior space is difficult, but I think if it's the right management team with the right commodity in a jurisdiction that's manageable, then they can attract the finance. It's not that there's a shortage. I don't think there's any shortage of money, but ultimately investors that are in the business of managing their risk, and they'd like to see returns. So the juniors are becoming more important, of course, for the mid caps and also the majors, because the tier one companies for literally decades now have no longer had major in-house exploration and development teams looking for replacement ounces or replacement pounds of copper within their own portfolios. That this is how the junior space actually was created, to enable these companies, prospect generator companies, who will go out there and find prospects and then flip those prospects onto other companies, developers, who will take it further up the value chain, and then ultimately being bought out by an operator and maybe constructed by that operator and then operated. So it's a volatile and a difficult space, is the junior space, and I think we have seen a clear out to a large degree, especially many of the publicly quoted juniors. I mean, literally, it's not one or two. It's tens and even hundreds of companies that have died and disappeared, in particular in the last 5 years, because of the lack of performance. People that have, not been using shareholder funds well. I mean, if you find a company that raises $5 million and they spend 75% of that money on general and administration costs, some would turn lifestyle costs, management salaries, travel budgets, etc., instead of putting it into the ground in the project, then there's a problem. But those that have invested management, people that have actually own shares, actually put their own money in, or sweat equity or their time in order to create value for the other shareholders, well, those companies tend to attract the capital that they need to move their projects up the value chain. So it really is a question of finding those gems, if you like. And as I say, those companies continue to do well, and ultimately they become targets for the mid-tier and the tier one companies who will take them out. Either they will buy one of their assets or they'll take out the whole company. And that management will then move on to the next opportunity because that's what they do. That's the space they operate in. But I see more and more focus on that, on the quality of the junior company, and then those quality ones will get swallowed up by the bigger companies. So lots of exploration activity continue to be needed. The funding of exploration will continue to be difficult, as I say. If you look at most of the world today, jurisdictionally, the traditional tier one mining jurisdictions have been severely impacted by change of government control. More in South America, for example, you've got more and more this strongly socialist governance, and those governments have been cancelling mining permits of major operators, refusing to extend the life of their licenses, and even shutting down operations. I mean, the most recent one that everybody would be aware of course, is First Quantum's El Cobre Panama operations. A big tier one copper operation. They got the permit from the government, and then the new government decided that, listening to certain groups of people who said that the mining is bad, and after, I think First Quantum put $12 billion or $15 billion into developing that mine, the mine was shut down. And who loses? Well, everybody loses. Certainly the shareholders of First Quantum lost out. But the country as a whole, Panama, the stakeholders, the population, the job losses, I mean, that was a tier one mine, long life, would have been well beyond 20 years. Yeah, it's very sad. But this is what you're seeing. So finding a safe jurisdiction with a government that's supportive of mineral resources and mining development is also, is problematic. What we were discussing earlier, the whole thing about ESG, is something that's making it less easy. One of the things that I do see emerging because of ESG and because of the difficulty to develop new mines and the timelines is one area that's not really being addressed in the mainstream yet, but I really think it will become addressed in the mainstream, and that's the issue around the reprocessing of mine tailings and mine residues. I mean, the amount of mine residues that we have around the world is just simply, staggering. I mean, let's take South Africa, for example, where I live. I mean, there's about current estimates around 800 million tons of gold tailings containing around 30 million ounces of recoverable gold. I mean, that's roughly the equivalent of 6 tier one gold mines just in tailings. Now, these tailings sit on operations which have closed or have been mothballed, that are already permitted effectively, already have systems in place that could be managed. So using available technology, you can go in and process those gold tailings and produce at a much lower capital cost than producing or going to find a new mine. And also, of course, the timeline is much shorter too. I mean, globally, available gold tailing estimates are about 20 times that, so probably around 16 billion tons containing 450 million ounces of gold. So that's like 90 tier one gold mines just in tailings. That's the residues from old mines. So I really think that, given the capital intensity per ounce is 90% lower than finding and developing a new mine, and that the energy return on the amount of energy one has to invest to process those tailings is significantly higher than primary mine development and operation. I see that as a real thing for the future. And then if we talk about the critical metals for the energy systems, modern energy systems like nickel, I mean, there's estimated around 15 billion tons of nickel-bearing tailings around the world. I mean, that's 45 million tons of nickel contained and about 10 million tons of cobalt. Again, similarly with a capital intensity 80 to 85% lower than if you were to build and find a new mine. Copper is huge. Current estimates for copper tailings from copper producers around the world is about 150 billion tons of tailings. I mean, that's 300 million tons of copper contained in there that could be, with today's technology, could be reprocessed. And so why would you spend, 15 or 20 years going and finding and developing a new mine at very high capital cost when you can simply go back and reprocess these tailings? Now, some of the companies are, to some degree, are doing that. In South America, the big companies like Codelco are looking very seriously at being able to sustain their current production levels, because their production levels from primary mining is falling because grades are falling and the costs are rising of primary mining. They're looking very seriously at their hundreds and in fact billions of tons of tailings. And so I think this is a trend that we're going to see going forward, is more and more attention to the recovery and reprocessing of tailings from old mines.
Alan, thank you for your time. We've covered so many topics here. Obviously, we've spoken about gold, silver, PGMs, the critical minerals, battery metals, ESG, and a few other topics. And obviously, there's so much more to speak about. But really appreciate your time. Thank you for sharing your thoughts on a lot of those subjects. Some may be controversial. Some of our listeners may disagree, which is fine. This platform is here to educate the mining industry and keep people thinking and not always following the narrative. So I really appreciate your context and your thoughts on those various subjects that we've just covered. If our audience wants to reach out to you, if they've got any questions, if they want to follow some of the work that you're doing, how can they go about doing that? Social media platform channels are you on?
Well, I'm obviously active on LinkedIn. I mean, that's really the only social media channel, professional social media channel that I'm engaged in. I don't use any others, and prefer to have, direct discourse and dialogue, with my peers and fellow professionals and anyone, interested around the industry. And that can be contacted directly on my personal email address, which is amcminer@hotmail.co.uk or alanmclegg@gmail.com. And yeah, by all means, I mean, reach out to me. Happy to talk to people, debates, topics and views. That's the only way we progress as an industry. And the beauty about this industry that I've loved for the last 50 years is you never know everything. I mean, there's always something to learn. I learn something every day. And yeah, I think we have to always come back to try and empirical evidence, the facts, the realities, and focus on what we can control and not be driven by, hot air narratives that are there just for whatever reason. I really don't understand many of the narratives that are out there in the world. But anyway, we have to focus on reality. It would be my message. Thanks very much, Rob. Much appreciated. It's great to talk to you, and we'll do it again.
Yeah, certainly. And we've got a lot more, obviously, topics to speak about. So, certainly we do another one during the course of next year. Thank you for listening. Hope you enjoyed that episode. There's obviously a lot to unpack there. So you may have to listen to this episode twice. And obviously we covered a lot of different subjects. So appreciate your continued support. Please keep sharing these episodes far and wide. And especially with this episode, it'd be good to share it with people outside of our mining industry. Because obviously there's a lot of topics there that Alan's covered, and it will give a greater context of what our industry is about. And a lot of the themes that Alan has covered is, I suppose, talked about outside of our mining industry. So, please keep sharing these episodes far and wide. Thank you for listening. And until next time, happy mining.
Thank you for listening. Remember to reach out to Rob via the show notes and be sure to subscribe and leave a review. Until next time, happy mining, helping each other to improve the mining industry.